It at last worked out. Everybody believed that the Federal Reserve is giggling and it wouldn't raise rates. Since right now, obviously, raising rates will just make a downturn. The world is as yet experiencing the pandemic. Whole urban communities in China are a lockdown which is causing a deficiency of items on the lookout. The Federal Reserve was able to swallow an 8% expansion, as opposed to halting the monetary wheel. Be that as it may, without a doubt the inverse has occurred. Nobody anticipated the Fed to raise the rates by 0.5%. It's the greatest spike in 22 years. The main explanation that it presumably did that will be that expansion was genuinely going crazy. Expansion isn't a joke. Investigate nations who didn't treat expansion in a serious way. They have destroyed their economies from Weimar Republic in 1920s to Venezuela in 2013. Be that as it may, the most obviously terrible one was in Hungary in 1946, just after World War II. Eventually, expansion arrived at 13,600,000,000,000%, that is a great deal of zeros. Costs multiplied each 15.6 hours. Envision your Starbucks espresso dramatically increases each day. How might you set costs, pay rates, or then again burdens? The economy quits working, individuals lose confidence in the money. They begin trading merchandise for products since nobody knows how much the money would be worth tomorrow. On the off chance that you possessed a business, could you sell candy for $1 or $2? How would you set aside cash? There are a large number of inquiries that should be responded to. Your investment funds relatively soon would lose half of their worth. At the end of the day, on the off chance that an 8% expansion rate previously caused such a major issue, envision what occurs on the off chance that it's a little more than a 100% abandoned with so many zeros, 13,600,000,000,000%. During the level of out-of-control inflation, Hungary's most noteworthy section bill was the 100 quintillion pengo, contrasted with 1944's most elevated category, 1,000 pengos. Thus, having a short recession is much better than let expansion go crazy. The inquiry is why raising rates is so significant. The cutting-edge economy is completely founded on obligation. The Fed has outright power over the economy since it's the source of the dollar. It makes the dollar and loans it to monetary organizations like banks, and then, at that point, the banks would loan them to organizations or people in type of home loans or understudy loans. The second the Fed raises rates, banks should raise their rates too, which will make acquiring more costly, which implies less individuals will actually want to get cash. With a $50,000 compensation, you are qualified for a lot greater credit in the event that loan costs are 3% than at 6%. And that implies when financing costs are raised, less cash will stream into the economy, which will dial back the economy as well as the other way around. The economy goes through cycles. It begins with an extension period, continues to develop until it tops someplace at the top, and afterward leisurely beginnings chilling off, and in the end falls into a downturn, and surprisingly, a downturn at times when the downturn endures excessively lengthy. When it arrives at its primary concern, it begins developing once more, it gets once again to the extension time frame until it tops once more, and a similar cycle occurs again and again. What makes a difference is on the off chance that the cycle in general continues to move up. A year prior to the pandemic, the economy has arrived at its pinnacle. It was only trusting that something will maneuver it into a downturn, which was the pandemic. Truth be told, it was the longest financial extension throughout the entire existence of the US. The last downturn wasn't quite as terrible as it might actually be since the Fed went past its breaking point by tossing, in a real sense, trillions of dollars into the economy. The main drawback was that we immediately escaped the emergency and have arrived at the pinnacle again, since expansion currently is becoming quicker than the economy. Haven't you perceived how resource costs like stocks, houses, or even crypto rose so emphatically in such a brief time frame? The most recent 2 years were totally paradise for crypto and tech stocks. I mean, a few stocks multiplied over such a brief time frame. Furthermore, how do we have any idea about that we have arrived at the pinnacle? Expansion is becoming quicker than the economy. Furthermore, going crazy. That is the reason the Fed brought the rates up in any case. 0.75% isn't exactly really high since back in 2019, when the economy arrived at its pinnacle. The Fed raised the rates to 2.4%. In this way, what will occur throughout the span of the following several years is that the Fed will in all probability continue to raise rates to settle the economy. I surmise such a forceful activity from the Federal Reserve was to tell everybody that the Federal Reserve is prepared to make any essential move to dial back expansion, and isn't simply giggling, since a great many people were sure that it wouldn't even for a second consider doing as such. Furthermore, presently the inquiry is the manner by which will that influence the securities exchange, land, or crypto. The response is basic and clear. An ascent in financing costs will diminish the interest, which will unavoidably lead costs to fall. Bitcoin is now somewhere around 9% at the hour of this content, and it could fall further when the video is out. The SP 500 is somewhere around 4% and the Dow Jones by 3.4%. That doesn't mean they will continue falling, yet there is most certainly going to less cash stream into unstable resources, for example, crypto or tech stocks. The stocks that appeared as though they are going to shoot to the moon will start to dial back, and the organizations that assume to fail during the pandemic will at long last face the truth where they should develop without the Federal Reserve's modest cash. Along these lines, it's totally commonplace to see a stocks to wane. Will that stop expansion? Indeed, the response is both yes and presently. That is, most importantly, without a doubt will influence house costs, for instance. Simply envision briefly what will end up selling rates. They will be so costly that individuals would prefer to decide to lease than purchase, which means costs will start to fall. The amount they will fall is still need to be worked out. However, a lodging emergency somewhat is conceivable. Anyway, with such a deficiency of houses on the lookout, nobody truly knows what's in store. And yet, not all expansion is a consequence of the Federal Reserve's activities. The 0.5% increment in rates won't cut down gas costs, since they are for the most part settled by OPEC, an association of sending out petrol nations that control the interest. Also, supply of oil on the lookout, and the conflict in Ukraine that is making shortage on the lookout, which is prompting such high gas costs, which are causing expansion around the world. Yet, what concerns me the most is that it will prompt a downturn. The pandemic crashed supply chains, annihilated what organizations have been working for quite a long time, and presently higher rates mean these organizations will have less assets to restore what they have assembled. At the point when the financial plan shrivels, organizations should cut costs, which can without much of a stretch lead to higher joblessness, since compensation are the greatest cost for most organizations. The results won't be clear right away. It will require some investment on the grounds that 0.75% isn't 5.25% like it was in 2007. Reprimanding the Fed. However, it is simple. Difficult to oversee such an emergency. On one side, We just escaped the pandemic that is not finished at this point. On the opposite side, there is a whole conflict occurring in Europe, Russia/Ukraine, which is making oil costs shoot to the moon, and that is raising costs for everything from the cost of driving your vehicle to your food. Gratitude for watching, and see you in the following one.